Welcome back to Fundamentals of Accountancy, Business and Management. In this video, we're going to talk about books of accounts. Content standard. The learners demonstrate an understanding of the two major types of accounts, namely journal and ledger. Performance standard. The learners demonstrate an understanding of the two major types of accounts, namely journal and ledger. Learning competencies. The learner shall be able to identify the uses of the two books of accounts, illustrate the format of a general and special journals, and illustrate the format of a general and subsidiary ledger. Now, at the end of this lesson, the learners will be able to identify the uses of the two books of accounts, the journal and the ledger, to record business transactions, explain the use of general and special journals to record business transactions, and discuss the use of general and subsidiary ledgers to record business transactions. First, let's have a quick review of the things that we studied in the previous videos. And the first one is the accounting equation. The accounting equation is assets is equal to liabilities and owner's equity. We also talk about 5 types of major accounts, and the first one is the assets. Assets are resources owned by the firm. Liabilities are obligations of the firm arising from past events which are to be settled in the future. Owner's equity is the residual interest of the owner from the business. It can be derived by deducting liabilities from assets. You have income. It is the increase in resources resulting from performance of service or selling of goods. And expenses, which refers to the decrease in resources resulting from the operations of the business. Now, we also talked about the chart of accounts, and it is said that a chart of accounts is a listing of the accounts used by companies in their financial records. It helps to identify where the money is coming from and where it is going. And it is also the foundation of the financial statements. Now, before we continue with the lesson proper, let's also look back at the definition of accounting. Accounting is the process of identifying, recording, and communicating economic events of an organization to interested users. Now, with this definition, we can ask questions like, where do we record the transactions that we have identified, or what are the tools that we use to document these transactions, and how important are these records in accounting? These are the questions that we're going to answer in this video. Now, we're going to be talking about two major types of books of accounts, and we have here the journal and the ledger. The journal is also known as the book of original entry. Companies initially record transactions and events in chronological order. That means they are recorded in the order in which they occur. So the first transaction that happens first is recorded first, and then the one that follows, and so on. Now, this is the reason why the journal is referred to as the book of original entry. Now, for each transaction, the journal shows the debit and the credit effects of specific transactions. And there are 2 types of journals. The first one is the general journal. The general journal is the most basic journal, and typically it has spaces for dates, account titles and explanations, references, and also 2 amount columns. As you can see in here, the journal makes several significant contributions to the recording processes. First, by disclosing in one place the complete effects of a transaction. In the general journal, you can see which account titles are affected. You can see how it affects the asset, the liabilities, or the owner's equity just by looking at the general journal. Now, it also provides a chronological record of transactions. Just like what I said earlier, when we make journal entries, it is based on the order on when the transactions happen. It is written, or we input the transactions in chronological order. It also helps to prevent or locate errors because the debit and credit amounts for each entry can be easily compared. You can easily see whether your debit amount is equivalent to your credit amount by just looking at this general journal. Now I'm going to discuss the journalizing process. How do we use the journal? This is how a general journal looks, and the first column is the date. So this is where you enter the date of the transaction. If it happened on October 15th, 2020, then you write the date in here, October 15th, 2020. The next step and the next column would be the account title and explanation. This is where we enter the debit account title or the account to be debited. It should be placed at the extreme left margin of the column, headed account title and explanation. And then the amount of this account title should be in line and written under the debit column. Again, the debit account title, which is entered first, should be at the extreme left margin of the column headed account titles and explanation, and the amount of the debit is recorded in the debit column, just right here. Now, the credit account title should be indented and entered on the next line in the column headed account titles and explanation. So as you can see in here, our debit is cash, and then now we're going to credit Jasmine Batawang Capital. So this account title that should be credited should be indented. So it's not in the same margin as the account title that you're going to debit, all right? And then the amount corresponding to this account title should be written in line, but under the credit column. So you debit cash and you put the amount under the debit column. You credit Jasmine Batawang Capital, it should be indented, and the value should be under the credit column. Now we also include a brief explanation of the transaction, and it appears on the line below the credit account title. So as you can see in here, below Jasmine Batawang Capital, you can see a brief explanation of the transaction, and it says to record initial investment of the owner. Now, if you have to enter another journal entry, then you have to leave a space and then you can start with another journal entry. Again, there should be a space between journal entries. That will make the entire journal easier to read. Next, the column titled Ref, which stands for reference, is left blank when you initially enter the debit and the credit account titles. This column will be used when you transfer the journal entries into the ledger accounts. So things that you have to remember: it is important to use correct and specific account titles in journalizing. If you make mistake in your journal entry, then you're going to have mistakes also in posting to your ledger. The main criteria is that each title must appropriately describe the content of account. If you remember in our discussion of the chart of accounts, there's a part where each account title is given a description. So you would know which account title you have to use for the transaction that you're analyzing. Next, some practitioner or CPA uses description or particulars instead of account titles and explanation, but they definitely just were just made for the same purpose. Be reminded that for every journal entry, the total debits and credit should always be equal. If not, the entry is erroneous. And that is also true. If your debit is, let's say, 10,000, and then the amount of your credit should also be 10,000. They should always be equal. Now let's go over some transactions and see how each transaction is going to affect account titles and how we're going to put the entries in the general journal. The first one is this: September 1st, 2015, Mr. Jasper Reyes invested 500,000 pesos in a restaurant business by opening an account with Super Savers Bank. So the date goes in here, that's September 1st, 2015. So September 1st, 2015. And our debit, the account to be debited is going to be cash because the business received 500,000 pesos in cash because Mr. Reyes invested it. So we received cash and the amount goes here under the debit column for 500,000. Now, the account to be credited is J. Reyes Capital, which represents the equity of Mr. Jasper Reyes. Since he invested 500,000 pesos, then we also record 500,000 pesos for his equity in the business, and that is under the credit column. Remember, we have to put a brief explanation of the transaction, and for this transaction, we write to record initial investment of Mr. Jasper Reyes. For the second transaction, we have September 5th, 2015, purchased kitchen appliances for his business amounting to 100,000 pesos by issuing a check. So again, we start with recording the date when the transaction occurred. And this is September 5th, 2015. So we put in here September 5th, 2015. We purchased kitchen appliances. So the business received an asset. And increase in asset is a debit. So we debit the account title kitchen appliances. Remember, it should be at the extreme left part of this column. So we debit kitchen appliances and the amount of the kitchen appliances is 100,000 and we put it under the debit column. Now, this kitchen appliances was purchased by issuing a check. That means we paid for it. So there is a decrease in our cash since we paid for something that we purchased. Then we have to credit cash. So when we enter the account to be credited, it has to be indented and the amount is in the same line going under the credit column, right? So you have the debit account title and the account to be credited, and then your debit value is equivalent to your credit value. So this is how we journalize this transaction. Next, September 6, 2015, started his operations and made a sale for that day amounting to 20,000 pesos. So we start with the date, that's September 6, 2015. The business made a sale and received 20,000 pesos from that sale. So we debit cash and the amount goes here under the debit column for 20,000. We received this cash because we made sales. So we credit sales. This is indented. And the amount of the sales goes right there under the credit column. So we have debit cash, credit sales. The amount of debit is 20,000 and our credit is 20,000. It's equal. Another one. On September 7th, 2015, Mr. Reyes purchased a motorcycle costing 80,000. He pays 30,000 cash and agrees to pay the remaining 50,000 on account, which is to be paid later. Some entries involve only two accounts, one debit and one credit. An entry like that is considered a simple entry, but some transactions, however, require more than two accounts in journalizing. An entry that requires three or more accounts is called a compound entry. All of the transactions in the previous examples are simple entries, but this time we're going to have an example for a compound entry. Mr. Reyes purchased a motorcycle, so the business purchased an asset. After writing your date in here, that's September 7th, 2015, you're going to debit transportation equipment. Again, the account title depends on the chart of accounts that the business has. So if it's transportation equipment and the value goes under the debit column, that's for 80,000. And then he paid 30,000 in cash. So the cash decreased and it is the amount to be credited. The amount of cash that he paid is 30,000. So we put in here 30,000, but there's a balance and it is to be paid later. And this amount, which is on account, will be recorded as accounts payable, and the amount is 50,000. Your explanation is to record purchase of motorcycle by paying cash and the balance on account. So your debit side is 80,000. And if you're going to add up the credit side, it's 30,000 plus 50,000. It's also equivalent to 80,000. So this is an example of a compound entry. We have transportation equipment, cash, accounts payable. So you have three account titles involved in one journal entry. The second type of journal is the special journals. The first one is the cash receipts journal. It is used to record all cash that has been received. Cash disbursements journal, used to record all transactions involving cash payments. And then the sales journal, or the sales on account journal, is used to record all sales on credit or sales on account. And finally, we have the purchase journal, or the purchase on account journal. It is used to record all purchases of inventory on credit or purchases of inventory on account. Now we're going to start with the cash receipts journal. Again, cash receipts journal is used to record transactions involving receipt or collection of cash. So every time cash goes into the company or into the business, we record this receipt in the cash receipts journal. The following illustrate the format of a cash receipts journal, as you can see in here. But remember that the format may vary depending on the nature of business and the frequency of transactions. So this is just a sample of a cash receipts journal. We have here the column for the date. So the date of the transaction is entered here in the date column. Then we're going to write a brief explanation of the transaction in the description column. And then in this column, the column titled ref, or it stands for the word reference. This is left blank when the journal entry is made. This column is used later when we transfer the journal entries to the ledger accounts. Now we have the debit column, cash. It represents the amount of cash received for a particular transaction. So this is where you put the amount of cash that you received. Okay, and we've got three other columns in here. These are the major categories of receipts. You have cash sales, you have the collection of accounts receivables, and the sundry column. So basically, when you do cash sales, then you receive cash and they record it as revenue. So one of the major credit account would be sales. And then we also receive cash when we collect accounts receivable. So there's also a special column for that. Now, for the column sundry, it is used for various miscellaneous and less regular items, because we can say that the sales transaction, the cash sales transaction, as also the collection of accounts receivable, is something that is frequent and repetitive. But for the sundry, these are for less regular items such as capital investment or receipt of loan proceeds, among others. So there are also other transactions wherein the business receives cash, but not as frequent or as repetitive as having cash sales or collecting accounts receivable. The information that you're gonna put in this cash receipt journal should come from a source document, and the main source of document for this journal would be the official receipt or the cash receipts that the business issued to the customers. Second special journal is the cash disbursement journal, cash disbursements journal. The cash disbursements journal is the opposite of the cash receipts journal. So when the business receives cash, we put it in the cash receipts journal. And now when we pay cash, or when the cash goes out of the business, then we record the transaction in the cash disbursements journal. So basically, it is the journal where all cash payments are recorded. An example of a cash disbursement journal is here, the one in the slide. And the first column would be for the date. So again, this is where we record the date of the transaction. We put it in the date column. Now, just like in the cash receipts journal, there's also a column for the description of the transaction. So we write here a brief explanation of the transaction, similar to the explanation that we use when we put journal entries in the general journal. Now, the third column would be reference. And again, this is left blank when we make the journal entry initially. But then when we transfer the journal entry to the ledger, then we have to put the reference pages in this column. And next would be the check or voucher number. This represents the identifying number of the check issued for the related cash payment. And most of the time, a check or a cash voucher accompanies the disbursement, and the voucher number may be used as an alternative for this column. So if the business is going to issue a check as payment, then you have to write the check number. Otherwise, if the business is going to use the cash on hand and will just issue a cash voucher, then the voucher number should be recorded in this column. The next column would be we have here the debit columns. So again, the debit cash column. Now let's take a look at the debit and credit columns. As you can see in here, the account title cash is under the credit column. When the business receives cash, cash is debited. And when the business pays cash, or when the cash of the business goes out, then we credit the account title cash. So in cash disbursements journal, cash is under the credit column. Now, when do we pay cash, or when this cash goes out of the business? So we have here some of the common recurring transactions for cash disbursement. And one of them is payment of accounts payable, especially when the business purchase, let's say, inventory or supplies like this. So we recognize accounts payable. So one of the most common transaction wherein we disburse cash, or the business disburses cash, is when accounts payable is paid. So there's a special column for accounts payable. Next would be salaries. So salary payment also results to disbursement of cash. And then this one, supplies, is when the business purchase supplies for business use, of course, then it can be debited as well. Now, similar to the cash receipts journal, we also have a column for sundry items. That means we're going to be using this for transaction that don't involve accounts payable, salaries, and supplies. The source documents used to update the cash disbursements journal are the check voucher No. 321. The source documents used to update the cash disbursements journal are the check voucher or the cash voucher. And you may also use the cash receipts or official receipts from suppliers or vendors. Now let's move on to the next special journal, which is the sales journal or the sales on account journal. The sales journal or sales on account journal is used in recording several sales transactions on account, right? So we sell something, or probably we give the service. For this one is merchandising. This one's for merchandising. So when we make a sale, but we don't actually receive the money yet, the payment yet, then we record it in this journal. The source document for this journal is the charge invoice or the sales invoice that we issue to various customers or clients. So in the sales invoice, we indicate there how much the customer should pay us for the items that we deliver to them. Now, an example of a sales journal is here. There's, of course, the column for the date. This is where we record the date of the transaction. And also there's a column for the description. We can put the customer name to give a brief explanation of the transaction. And also, we still have this reference column. Still, remember that when we record a transaction in the sales journal, initially, the reference column should be blank, should be left blank. We're going to be using this only when we transfer the information to the ledger account. Now, this column is going to be used later in later recording. There's a column in here which is charge invoice or sales invoice number. So if you give out or if you issue a charge invoice, then you put the number in here. If you issue a sales invoice, then you issue you record the number in here. It is the identifying number of the source document issued to the customer when the sale was made. So it is very important for review or for audit. So it can easily be traced where the transaction came from. Now we have this column for the accounts receivable as a debit for this sales transaction, sales and account transaction. So basically, when you have sales and account transaction, you debit accounts receivable and then you credit sales. So your debit in here is accounts receivable, and the next column is a credit column for sales. Again, the debit accounts receivable column represents the amount of the sale transactions indicated in the charge invoice. And the credit sales column represents the amount of sales transactions indicated in the charge invoice. Now, the source document again for this journal is the charge invoice issued by the business. The next special journal is the purchase journal. Purchase journal is the journal that we use to record purchases on account. That means we bought inventory, but we haven't paid for it yet. So that means that we purchased those items on account or on credit. You'd see the first column is for the date. So this is where you record the date of the transaction. The next column is description. So you can write the supplier's name. The next column is the description. It's where you put the brief explanation of the transaction, or you can write the name of the supplier. Now the next column is reference. You already know this one. It's similar to the reference column in the other special journals. Now, the next column, which is the charge invoice number or the sales invoice number, represents the identifying number of the source document issued by the supplier when the items, the goods, or the merchandise were delivered to the company when the purchase was made. Okay, so the last two columns that we have are the debit and the credit columns. Debit would be for purchases, and then credit would be for accounts payable. You already know that once the business make a purchase on account, then we debit purchases and then we credit accounts payable. Again, the source document for this journal is the charge invoice from the supplier or the vendor. Now let's move on to the other book of accounts, and that is the ledger. The ledger refers to the accounting book in which the accounts and their related amounts are recorded in the journal and are posted periodically. Now, the ledger is also called the book of final entry. If the journal is called the book of original entry, the ledger is called the book of final entry. This is because all the balances in the ledger are used in the preparation of your financial statements. Now, this is also referred to as the T account because the basic form of a ledger is like the letter T. Now, we have the first type of ledger, because we have two, the general ledger and also the subsidiary ledgers. Now, the general ledger is commonly referred by accounting professionals as GL. It is a grouping of all accounts used in the preparation of financial statements. We have the format of the general ledger. This is how the basic general ledger looks like. The account portion refers to the account title. For example, cash or accounts receivable or the other liability equity accounts. Then you can write the account title here, this line. Now, the account number, the one that you can see on the upper right, is the assigned number for which account title are given to facilitate ease in recording and cross-referencing. You remember in the chart of accounts, you have the account title and also the number that we assign for each account title. So that's the one that you're going to put in this part. And the date column identifies when the transaction happened. So you would see this, you will get this information from the original entry in the journal. Next, the item column represents the source journal and the nature of the transactions. The reference would still be the same. This is for cross-referencing. And the debit and credit columns are used for recording the amount of transactions from the general journal or from the special journal. Now, the balance column, which is the last one, it represents the running balance of the account after considering the debit and credit amounts. If the running balance is positive, the account has a debit balance. Whereas if it has a negative running balance, then the account has a credit balance. The next one is a subsidiary ledger. A subsidiary ledger gives you information about a group of like accounts that contains the independent data of a specific general ledger. So a subsidiary ledger is created or maintained if individualized data is needed for a specific general ledger account. One example of subsidiary ledger is the individual record of payables to suppliers. So the total amount of this subsidiary ledger should equal the balance in the accounts payable general ledger. In simple terms, you have an accounts payable general ledger, but the accounts payable recorded there are accounts payable to different suppliers. Now you can make separate subsidiary ledger for each supplier. And that is this one, the accounts payable subsidiary ledger. This is an example of a subsidiary ledger. Now, the upper portion indicates the name and the address of the vendor or the supplier. So you would see here the vendor or supplier name is Joy Food Corporation and the address is Jose Street, Sampaloc, Manila. Now, the vendor number is assigned number for each vendor. There's an assigned number for each vendor, and that is for reference or for keeping the records of a supplier. In this case, Joy Food Corporation is vendor number 201. The number of the vendor, of course, depends on the business. So the business will be the one to assign the vendor number for each supplier. Now, this first column, which is the date column, it identifies again when the transaction happened based on the original entry recorded in the journal. Now, the description column describes the nature of your transaction. There's also a reference column and the debit credit columns, which reflect the various effect of every transaction to the record of the supplier or the vendor. Supplier or vendor. Now, the balance column is similar to the general ledger. It is the running balance of every supplier. So one important thing is that the total running balance of all subsidiary ledgers should equal the accounts payable general ledger. Okay, so if your accounts payable general ledger balance is 100,000, then if you have, let's say, 10 vendors, so you have 10 accounts payable subsidiary ledger, if you add up all the running balances of those subsidiary ledger, it should also be equivalent to 100,000. So the balance of all subsidiary ledgers should tally with the total balance of the accounts payable general ledger. Okay, that's it. So again, there are two types of ledgers, the general ledger and also the subsidiary ledgers.